Welcome back, it's Jade Sinclair, and today we're unpacking FICO versus VantageScore, the two scoring models lenders use, and exactly what's pulling your number up or down.
Here's what they don't tell you. Most people spend years trying to improve their credit score without even knowing which credit score lenders are actually looking at. You check one app and see a score of 720. Another website says 690. Your bank shows something completely different. So which number is correct? And more importantly, which one actually matters? The answer lies in understanding the two biggest credit scoring systems in America, FICO and VantageScore. While they may seem similar at first glance, they calculate your credit worthiness differently, and knowing how they work can help you make smarter financial decisions. If you enjoy videos that simplify personal finance and break down complicated topics into plain English, make sure to subscribe because today we're diving deep into the world of credit scores. 1. What is a credit score? A credit score is a three-digit number that represents your creditworthiness. In simple terms, it tells lenders how likely you are to repay borrowed money responsibly. This number plays a major role in many financial decisions, including whether you qualify for a credit card, auto loan, mortgage, or personal loan. It can also affect the interest rates you receive. A higher score often means lower borrowing costs, while a lower score may result in higher interest rates or even loan denials. That's why understanding your credit score is one of the most important parts of personal finance. Think of your credit score as your financial reputation condensed into a single number. Just as employers may review a resume before offering a job, lenders review your credit score before deciding whether to lend you money and on what terms. A strong credit score can help you qualify for lower interest rates, higher credit limits, and better financial opportunities over time. On the other hand, a poor score may make borrowing more expensive and limit your options. This is why understanding and protecting your credit score should be an essential part of every person's financial journey, regardless of age or income level. 2. Why are there different credit scores? This is where many people become confused. There isn't just one official credit score. Instead, different companies use different formulas to evaluate your credit history. The two most popular scoring systems are FICO and VantageScore. Both use information from the major credit bureaus Experian, Equifax, and TransUnion, but they don't always weigh the same factors in exactly the same way. As a result, it's completely normal for your FICO score and VantageScore to be slightly different. That doesn't mean one is wrong. It simply means they use different methods to analyze the same information. The existence of multiple credit scores doesn't mean the system is broken. Rather, it reflects the fact that different companies have developed their own methods for predicting credit risk. Each scoring model uses complex algorithms and statistical data to estimate how likely someone is to repay borrowed money. Because lenders have different priorities and risk preferences, they may choose the scoring model that best fits their needs. As a consumer, the most important thing to remember is that while the numbers may vary slightly, responsible financial habits such as paying bills on time and keeping debt under control will benefit you across nearly all scoring systems. 3. What is a FICO score? FICO stands for the Fair Isaac Corporation, the company that created the scoring model decades ago. Today, FICO remains the most widely used credit scoring system in the United States. In fact, the majority of lenders rely on some version of a FICO score when making lending decisions. FICO scores generally range from 300 to 850, with higher numbers indicating stronger creditworthiness. The system evaluates several important factors, including payment history, credit utilization, the length of your credit history, the types of credit you use, and recent credit inquiries. Because FICO has been used for so many years, many banks and mortgage lenders consider it the industry standard. 4. What is a VantageScore? VantageScore was developed jointly by the three major credit bureaus as an alternative to FICO. Like FICO, it also uses a scale ranging from 300 to 850. However, the scoring model is different in several important ways. One major advantage of VantageScore is that it can generate a score for consumers with shorter credit histories. This means people who are relatively new to credit may receive a VantageScore even if they don't yet qualify for a FICO score. VantageScore also places different emphasis on certain factors, such as recent credit behavior and total balances. Because of these differences, your VantageScore may sometimes be higher or lower than your FICO score. 5. How FICO calculates your score. FICO uses 5 major categories when calculating your score. Payment history is the most important factor because lenders want to know whether you've paid your debts on time. Credit utilization is another major factor and refers to how much of your available credit you're currently using. The length of your credit history also matters because longer histories provide more information about your financial habits. FICO also looks at your credit mix, meaning the different types of accounts you have, and recent inquiries, which show how often you've applied for new credit. Together, these factors create a picture of your overall financial behavior. 6. How VantageScore calculates your score. While VantageScore considers many of the same elements, it organizes and weighs them differently. Payment history remains extremely important, but VantageScore also pays close attention to your recent credit activity and total debt balances. The model is designed to respond more quickly to changes in your credit behavior. This means improvements such as paying down debt or reducing balances may sometimes affect your VantageScore faster than your FICO score. However, negative events like missed payments may also impact the score quickly. Understanding these differences helps explain why your scores may not always move in perfect sync. 7. Which credit score do lenders actually use? This is probably the question most people want answered. The reality is that many lenders still rely heavily on FICO scores, especially mortgage lenders. However, some banks, credit card issuers, and financial institutions use VantageScore or other scoring models depending on their internal policies. In some cases, lenders may review multiple scores before making a decision. That's why focusing too much on a single number can be misleading. Instead, your goal should be maintaining strong credit habits that improve your overall credit profile, regardless of which scoring model is being used. 8. Why your scores may be different. One of the biggest surprises for consumers is discovering that their scores don't always match across different websites or apps. There are several reasons for this. First, different scoring models may weigh factors differently. Second, some lenders report information to only one or two credit bureaus instead of all three. Third, your credit reports may update at different times. All of these factors can create small variations between your scores. Rather than worrying about a few points here or there, focus on the overall trend. If your credit habits are improving, your scores will generally move in the right direction over time. 9. How to improve both FICO and VantageScore. The good news is that the strategies for improving both scores are remarkably similar. Pay all of your bills on time because payment history is one of the most important factors. Keep your credit card balances low and avoid using too much of your available credit. Limit unnecessary credit applications. Maintain older accounts whenever possible, and monitor your credit reports regularly for mistakes. Building excellent credit doesn't happen overnight, but consistent financial habits can produce impressive results over time. In addition to these habits, patience is incredibly important. Many people become discouraged when they don't see immediate improvements, but credit building is a long-term process. Every on-time payment strengthens your credit profile, and every responsible financial decision adds to your credibility as a borrower. Small improvements made consistently can eventually lead to significant changes in your credit score and open the door to better financial opportunities in the future. 10. The truth about perfect credit. Many people dream of achieving a perfect credit score of 850, but the truth is that perfection isn't necessary. Most lenders already consider scores in the excellent range to be highly favorable. Chasing the perfect number often creates unnecessary stress. Instead, focus on building healthy financial habits, managing debt responsibly, and maintaining consistent payment behavior. A strong credit profile is far more valuable than obsessing over a few extra points on your score. The truth is that credit scores aren't meant to define you, they're simply tools used by lenders to evaluate risk. Whether your score is currently excellent, average, or still improving, the important thing is understanding how the system works and using that knowledge to make smarter decisions. Once you understand the difference between FICO and VantageScore, you're no longer guessing about your financial health. You're making informed choices based on facts. At the end of the day, building great credit is less about chasing numbers and more about developing long-term financial discipline. The earlier you learn these principles, the more opportunities you'll create for yourself in the future. If you found this video helpful and want more easy-to-understand finance content, don't forget to subscribe, and I'll see you in the next video.
Now that you know what's really moving your credit score, you can start making moves that actually count. Drop a comment, hit subscribe, and let's keep building.